Every financial expert on the internet has a hot tip, a secret strategy, the best time to buy. Here's the dirty secret. The most reliable investing strategy is boring, mechanical, and available to anyone. It's called dollar cost averaging, and by the end of this video, you'll understand why it beats market timing for almost everyone, and how to do it automatically. Dollar cost averaging, or DCA, is the practice of investing a fixed amount of money at regular intervals, regardless of what the market is doing. Every 2 weeks, every month, every paycheck, you invest the same dollar amount, no matter if the market is up, down, or sideways. That's it. That's the whole strategy. The genius is in its simplicity. Let me show you why it works with a concrete example. Say you invest $300 every month into an S&P 500 index fund. In January, the fund costs $100 per share. You buy 3 shares. In February, the market drops. The fund is now $75 per share. Your $300 buys 4 shares. In March, it recovers to $90. You buy 3.3 shares. You invested $900 over 3 months. You own 10.3 shares. Your average cost per share is $87.38. The current price is $90. You're already up, even though the market dipped hard in February and hasn't fully recovered. That's the power of DCA. When prices drop, you automatically buy more shares for the same money. When prices rise, you buy fewer shares, but you already own more from the dip. It naturally takes advantage of volatility without you having to do anything. The alternative to DCA is lump sum investing, putting all your money in at once. Studies actually show that lump sum investing outperforms DCA about 2/3 of the time in historical data because markets tend to go up over time. The earlier you're invested, the more time you have compounding. But, and this is a big but, that only works if you have a lump sum available. Most people don't. Most people get paid every 2 weeks and invest what they can from each paycheck. For them, DCA isn't a choice. It's the only option. More importantly, even people who do have a lump sum often can't emotionally execute lump sum investing correctly. You have $20,000 saved up. The market just hit all-time highs. Do you really invest it all at once? Most people hesitate. They wait for a dip. The market keeps going up. They miss months of gains. Then when it finally drops, they panic and don't buy. Then it recovers and they kick themselves. This is called market timing, and it's almost impossible to do consistently well. Studies show that average investors significantly underperform the market, not because they chose bad funds, but because they bought at highs and sold at lows. Dollar cost averaging removes the emotion from investing. You don't have to decide when to buy. You don't have to watch CNBC. You don't have to wonder if now is a good time. The calendar tells you when to invest. The same amount goes in every period. Done. Let's put DCA through a stress test. The 2000s are often called the lost decade for the stock market. If you had invested $10,000 in the S&P 500 in January 2000 and just watched it, by 2010 you'd have less than you started with. The S&P 500 was lower in 2010 than in 2000. But if you had invested $500 a month throughout that entire decade using dollar cost averaging, you'd be ahead. Because you bought heavily during the 2002 and 2008 crashes, you bought more shares at lower prices. When the market recovered, those cheap shares multiplied in value. Boring beats brilliant. Consistent beats clever. Every time. Now let's talk about how to actually do this. The goal is to make DCA automatic, so it requires 0 willpower. Here's the setup. Step 1. Choose your investment account. A Roth IRA is ideal for most beginners. Tax-free growth, accessible contributions. A 401k at work is also great, especially if there's an employer match. A taxable brokerage works too if you've maxed out tax-advantaged accounts. Step 2. Choose your fund. For simplicity, a total U.S. stock market index fund or S&P 500 index fund is a solid choice. At Fidelity, FZROX or FXAI. At Vanguard, VTI or VO. At Schwab, SWTSX or SCHB. Step 3. Set up automatic investment. In your brokerage account, find the automatic investing or recurring investment feature. Set a fixed dollar amount to invest on the same day every month, or every 2 weeks if you get paid bi-weekly. Link it to your checking account. Step 4. Don't touch it. This is the hardest part for some people. When the market drops 20%, every instinct screams, sell, stop the bleeding. Don't. The drop means you're buying shares on sale. The automatic investment will buy even more shares at lower prices. Let it run. Step 5. Increase the amount over time. Every time you get a raise, increase your automatic investment. Even $50 extra a month makes a meaningful difference over decades. Let's see what consistent DCA actually produces. $300 a month, every month, invested in a total market index fund, 7% average annual return. After 10 years, $49,600. After 20 years, $157,000. After 30 years, $378,000. After 40 years, $833,000. You contributed $144,000 over 40 years. The market turned it into $833,000. That's the compounding that DCA unlocks, not through genius stock picking, but through time and consistency. One more thing. Don't stop investing when the market crashes. This is when most people quit. It's the worst possible time to stop. The 2008 financial crisis, the 2020 COVID crash, every major downturn. The people who kept DCAing throughout recovered faster and ended up with more than people who paused and waited to feel safe again. Warren Buffett's famous line applies perfectly to DCA. Be fearful when others are greedy and greedy when others are fearful. Automatic investing through a market crash is the best real-world application of that principle. Let's recap. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of market conditions. It removes emotion from investing, naturally buys more shares when prices are low, and historically beats trying to time the market for real-world investors. Set up automatic investments into a low-cost index fund, contribute consistently, and don't stop when things get scary. Boring investing